everybody. Good morning, good afternoon, and good evening, depending on where you live. And we do have traders from all around the world. So thanks very much for joining us for this New York trading session. You know, when we sit down to trade, we never know with certainty what the market will provide. And of course, when a trade is entered, we never know with certainty which direction the market will move. So there are several things that you may get to see today. If we get into a losing trade, you'll see the power of max risk management as it protects the account and minimizes the loss. If we get nice movement today, you'll see a winning trade, and you'll get a look at how we maximize the gains, take the best advantage of the movement. Or if the market gives us nothing but untradeable choppiness, you'll get to see how Max keeps you away from the bad trading conditions, again, protecting your account. Please feel free to ask questions in the question area of GoToWebinar, but be aware that we are concentrating on trading today, so there will likely be a delay before you get an answer so that we can attend to the charts properly. No matter what happens in the market, you're going to learn a lot today from Eusebio, a wonderfully skilled trader, a fine teacher, and you're in very good hands as we take a look at this New York trading session. Thanks for doing this, Eusebio, and I'll give the microphone to you.
So welcome to everyone, and I have chosen this morning, following my daily preparation routine, some pairs containing at least the yen, at least the Aussie, and the pound. Because of the global situation, we have usually a weak pound, we have a strong yen today, we have a weak Aussie, and so this allows to choose some of the pairs which may be interesting to follow. There is something which is also important to understand in our trading approach. The stop loss is not called a stop loss, it is called an ESL, an emergency stop loss. And the aim of this emergency stop loss, you see that regularly I adjust the stop loss along the trade, depending on what the price is doing. Oh, we have to pay attention here, we may have a possibility. Let me check. Yes, this on the Aussie yen may be set a bar. Let me check quickly the other pairs. A quick look before going into this way, because I have been pointing some other possibilities. Not here, not here, not yet. Here we have a max standard entry setup. I will handle it at the close of this candle, most probably. And so here we have a setup bar forming, and the bar will close in a few seconds. So let's check carefully that candle. And we may have also one here on the pound yen to go short. And I will come back to the explanation I was giving later. Now, when we trade live, when we make really our trades with MetaTrader platform, we have a tool which is called the MTM, the Max Trade Manager, the Max Trade Manager, which make in just one click button many steps. Let me check here. Yes, we have a setup bar here, this one. We have a setup bar here. So in this case, let me enlarge this chart. Let me prepare the trade. So what we do with our max trade monitor, we have a stop loss which is already predefined on the chart, and we adjust the stop loss. I will simulate that manually. So the stop loss normally would be somewhere in this area. We have a spread of 3 pips, so the stop loss should be in this area. This would give us a stop loss size of around 25 pips, and the entry would have been made. And so with our max MTM tool, we fix our stop loss size, and when we push on the sell button, we have automatically the entry with the trade size being calculated automatically. Okay? So we don't have to care for the trade size calculation. So here we have a stop loss of 25 pips. And so all these steps are made in one click with our max trade monitor. So it takes just the time to adjust the stop loss on the place where we have to place the stop loss and to push on the button to open the trade, and we get all the information related to the trade. Now that a trade is open, we have to follow that trade. And so the setup I have marked corresponds to one entry setup, which we call here a breakout remo. And I will note that on the chart. Breakout remo. Breakout because, as you can see, I have drawn here a support level, and my setup bar was coming. I will not give all the details, of course. My setup bar was the bar making the breakout, but that candle itself must fulfill also some conditions to have a valid setup and so a valid entry. One thing we have to pay attention also when we open a trade is the news release. We never trade in small time frames, and I call the small time frames all the time frames up to the 1 hour, even the 4 hour time frames. Starting with the 4 hour time frames, we consider the other time frame as the high time frames. So with small time frames, we have to pay attention to all the important news. And when we are facing such a news release, we don't trade, we don't open a trade, or if we are in a trade, we close the trade sometimes before the news is released. Okay. I'm sorry, Brian. Maybe the problem is on your end, because many says that the sound is okay on their side. Well, while the price is moving here, I'm going to explain the other example I have been pointed. It was here the euro pound. The euro pound, the same kind of setup, a breakout remo, and then a nice up movement, an exit in this area following our exit rule. One group of exit techniques we have is the use of an indicator like that oscillator. But we have other exit rules. I will come back later to such an example. So here we have an exit, and then later on the second exit here, and this was a very nice movement given a good trade for the max primer or the max light. So here the result was 55 and 95, 54 and 95, 149 pips, and the reward to risk ratio was plus, so we have to divide by 2 times 41, so 1.82 Rs, which is a trade size for the max light and the max primer on average larger than the average result we get. But sometimes we may have that when we have very volatile pair. And now we are expecting for another trade. We are here in what we call the concession zone mode. So we have to wait for an appropriate setup corresponding to that price mode. If I come back now to the Aussie yen, we see that the price is moving downward. We are now waiting for an exit conditions. I have mentioned also that here on the pound yen we had a max standard setup with this candle. I have not had the time here because I was explaining here what I was doing to mark the chart, but you see the price is going downward. Okay, so the entry would have been made. Let me indicate the, and by the way, we have also now a setup in the Euro USD, but I don't like that configuration. It does not fulfill all the ideal conditions we want to see in our setup. So when we don't have ideal setups, this is the same case with the Euro Aussie, we skip the trade. And so here, let me mark where the entry would have been made. The entry would have been made somewhere here, and the stop loss would have been placed here at around 40 pips plus the spread, so 44 pips for the spread here. And once we are in a trade, and by the way, when I trade myself, I never trade more than 2 pairs simultaneously. So I ignore the other pair. I have a look to what the other pairs are doing, of course, but what I do is I focus on the pairs I'm in, checking for every exit rules we have at our disposal, or when I trade with the max standard or any other levels, so especially the max ETF, then I check also very, very carefully for any possibilities of scaling. The scaling consists in adding to the trade when we can add to the trade. There are specific conditions to do that in order to have a strict trade risk management, in order for the risk to not explode, because when the risk becomes too large, the trade can be very dangerous for the account. So we want to master, we want to control the risk we are having in the trade. Now, this is not, Oscar, an ETF presentation. It is a general presentation, so I'm using the max prime or max light level. But if we have some opportunity for scaling, I will explain. And if we have some time later, I will give just a quick explanation of what the max ETF is, even if I will use the template for the max light. This is not a problem. Yes, Ralph, this session is recorded. As you can see, on your control panel of GoToWebinar, you have at the bottom of the panel a small red dot. That small red dot indicates that the session is recorded, and it will be made available. So all our trades entries are based on an on an entry setup. We call a setup, in fact, a set of conditions we want to see fulfilled. And so we have different situations. The different situations we can handle with the max depends on the type of movement the price is doing. Remember, during the presentation we have made last Saturday, we defined different price modes. The price modes represent what the price is doing. And so we have a trend mode, we have a counter trend mode. The trend mode is, just to be simple, when the price is moving in the direction of the trend. When the price is moving below the home base, we consider the trend is downward and we look for short trades only. The counter trend mode is when the price is moving upward, and vice versa if the price is moving above our home base channel. So we have the trend mode, we have the counter trend mode, we have, of course, criteria, rules telling us how to recognize as fast as possible such a mode, and usually 1 or 2 bars are enough to pinpoint or to recognize that price modes. Another very important price mode is the consolidation zone mode. We had the case here, in this case here. This is why the setup is called breakout, the breakout of a consolidation zone area. We have specific rules also to define the support and the resistance level of that consolidation zone mode. And for the consolidation zone mode, we have to pay attention to 2 different situations. We may have a large consolidation zone and we may have a tight consolidation zone. For a tight one, we wait for its breakout, which was the case here. And for a large one, we handle a large one in a different way. The consolidation zone mode can also be recognized with just 1 or 2 bars. Sometimes it may be a little more difficult when the price is also having a more global behavior, which is the choppy mode. The choppy mode is when the price moves in a very erratic way. And when the price moves completely erratically, it's really difficult to have or to trade the movement we are seeing. But fortunately, with the max, the way the max is designed and the way the setups, the entry setups are defined, we have very rarely an opportunity to trade when the price is in a choppy mode. And so we have plenty of time to recognize the choppy mode. And if it happens that we have a valid trade in a choppy mode, we have to handle that trade in a very, very careful way. Now, this is for the exit, the entry setup. So in each situations, we have 1 or several types of entry. With some variations, potential variations, possible variations. And so each setup is defined by a set of rule conditions to be matched. Similarly, we have the exit conditions. And so for us, the exit conditions is not based on simply using an indicator. Sometimes an indicator will fail to give a good exit. Let me give you an example here if I can see one. Here, if I take the pound yen here, okay? We have at the close of that candle a top in the store RSI. This is the stochastic of the RSI. We have also a divergence because we have lower lows, lower highs in the store RSI. We have higher highs in the price. And so what many traders will do is, because we have here an exit condition with the store RSI, an exit would be made here immediately at the open of the next candle. We do not use the indicator that way. We use the indicator in order to pinpoint very quickly and to quantify very quickly if the position we are trading may face a risk. And if this is the case, there are several steps to follow from the moment we pinpoint a potential risk and the moment we make the exit. And so the final decision is always made based on what the price is doing. Okay? So the indicators we are using are simply there to help us pinpointing these risky situations. We never know what the price will do. We never know what, it's not because we have a top in a store RSI in an up movement in the price that the price is reversing. We never consider the indicators as being predictive. They are not predictive at all. For example, here we have now, at the close of that blue bar, precisely with the store RSI, we have an exit condition. And we are here in what I call discretionary situations. When we have to make an exit, we have the possibility either to make the exit when the price shows to make the exit, in which case the exit would be made somewhere in this area. So in this case with no profit, break even minus the spread. Or we may decide to not to make that exit when we have a very specific situation, which is described in the course. So, and myself, I don't take such kind of exit. I prefer to wait for the price to move. I don't care if I have to close my trade with a full loss. Never on the stop loss. We never leave the price reaching the stop loss. The trade is always closed way before the price reaches the stop loss. If this is the case, I will illustrate what we do. So here, we may have an exit situation, and so what we advise to our students is when you trade live with the max at the beginning, when you have an exit condition which is triggered, make your exit. And when you will understand deeply that the risk we are taking is really small compared to the trade, and we will have losing trade, then you can use some more discretionary situations. A discretionary situation is never a situation when the trader has a total freedom to take his decision. The discretionary situations are always well described, and the key aspect of understanding that kind of situation and the decision we can take is always based on the trade risk management. Okay, we have similarly here on the, no, not yet. We don't have yet an exit setup, so, but I can prepare because we have to pay attention. So I don't take the exit here, okay? And so if this trade must be closed as a losing trade, I will probably make a larger loss than what most of the max trader will do. Because the advantage of making systematically the exit when the price goes against the trade, and then the second exit at a less favorable price, participate to minimize the loss on the trade. But when the largest loss is a small loss, we can be a little more flexible accepting these kind of discretionary situations. So we have exit techniques based on indicators, some indicators, oscillators, momentum oscillators, and in the max standard we also use some volatility oscillators. We have also another very important group of exit techniques which is based on the price action itself. In this case we have not only, so in this situation we have not only an exit setup which is preparing, let me change the color of that box in yellow. We have not only an exit setup which may be prepared with the help of this oscillator, but also with the price action itself. And it will be interesting to see. The candle will close in a little more than 1 minute, 1 minute and 15 seconds. And so we have some price pattern we use as our exit conditions. And sometimes these price patterns will give us an exit setup way before 1-2 bars before an oscillator give us an exit condition. Not always. Sometimes an indicator will give the exit condition before the price patterns, and sometimes the price patterns will give the exit conditions before a technical indicator. And this is the advantage of using these two groups of exit, because we want to be as accurate as possible, as fast as possible. Another group of exit technique is based on what we call the movement invalidation. Sometimes we can see the price going against the trade, and we have no exit rule triggering. And because we do not want the price to reach the stop loss, even the adjusted stop loss, we need to have a rule, we need to have another set of conditions to scratch the trade in order to minimize the loss we have on the trade. And so we have defined the concept of the movement invalidation. This is something which is based on more advanced concept, and I teach them way in details in the Max Advanced course. But it is a very simple rule, and this helps to exit the trade with usually a very, very, very small loss. So usually when we have a loss, a losing trade, the loss will be on average minus 0.4 or 5 Rs. So half of the risk we have when we open the trade. But very, very often we will have a loss smaller between 0.2 and 0.4 Rs. So very small loss, which can be recovered very quickly with one good winning trade. Susan asked, what is the name of the entry on the pound yen? On the pound yen, sorry, it is an, I have said, if you remember, that it is an entry based on the max standard, and it is in fact a pseudomo, a PIMO, a pseudomo. Most of our entry techniques up to the max standard level, so the max primer, the max light, and the max standard require that the 3 EMAs we are using are showing what we call angle separation and correct order. We explained what this means, in fact, in our course. And the pseudomo is one of the exceptions. We have 2 or 3 exceptions which are explained also why we can take these exceptions when we do not require that conditions on the 3 EMAs. And so you can see in this case, the price has retraced. And because I have chosen that discretionary situations to not to take my exit, and now the price comes back. And I have announced that I would not have taken my MX. And so I'm still in the trade with 2 units. Now, it may happen very frequently that when we have an exit in this situation, in this kind of situations, and the price comes back, we have closed 1 unit. Okay, that unit no longer participates to the trade. But with the max standard, when we have the scaling technique at our disposal, very often when the price comes back, we have an opportunity to make a scaling, to add to the trade. And when we open a trade with 2 units, the trade size is well calculated based on the financial risk we take and the stop loss size. We add 2 units having the same size as our initial entry. Okay, so let me see if we have here an exit rule based on our pattern. Yes, we have here an exit rule. We have a pattern here based on our price pattern exit technique, which would impose me to make an MX in that area, but I am exactly in the same condition as in this trade, that discretionary situation allowing me not to take that MX. Yeah, so I don't take that MX. I prefer to face a potential larger loss than to close one unit here. Okay? So George asked me, is it possible to change the color of your cursor? It is black on my screen, which makes it hard to follow. Unfortunately not. I don't think I can change the color of the cursor, George. I don't think so. But what I will do when I will explain something, I will enlighten the situation with a yellow box, okay? Or I will use the spotlight here, okay? The problem with the spotlight is controlled by GoToWebinar. I cannot mark my chart, so I need always to change the nature of the cursor. You can see here the situation I was explaining. The price pattern we have here gives an exit technique before the oscillator. The oscillator here on this candle now gives an exit condition too. So we have the exit condition 1 bar earlier than with the oscillator. But I have taken here my discretionary situation, deciding not to make that MX. But again, we advise to our MAX student, when they begin to trade with the MAX, to first of all take all the MX, all the exit they have on their chart. We can explore the discretionary situation with more experience, when we understand that we don't need to worry for a losing trade, because a loss is always a small loss. Now, when I am engaged in two trades, of course, I don't open another trade, but of course, I can check what the other pairs are doing. We can see that the euro US dollar is going upward. So this may influence the other pair also, like the euro yen. But sometimes the correlation is not good. Sometimes the correlation may disappear. The euro Aussie is doing pretty much nothing. The euro NZD is not presenting a good opportunity. And so the rules we have with the MAX, the exit rules we have with the MAX, help us to define, when necessary, the different scenarios we can face. For example, here we have two potential scenarios. Either the price will continue to go against the trade, and at some point I will have to take a decision to close the trade. And I know exactly in such a scenario where, hi Stanley, nice to see you. I know exactly in that first scenario, the scenario where when the price is going against the trade, I know exactly where to make my exit. And the second scenario is the price will come back. The price will resume the down movement, in which case I will know if I will have to make an MX or not, when I will have an exit condition. If I come back to the other pairs, so nothing on the euro US dollar, there was nothing. Yeah, there was a trade I have marked on the euro yen, and you can see 12 pips, 3 pips, so 15 pips in total. So here trade or result plus 15 pips, which represent a rework to risk ratio of, because the stop loss was 25, so plus 0.3 R. The pound yen we are in, the Aussie yen we are in. I have already explained this first trade. The euro Aussie, I have explained this trade. And the euro NZD, I have also explained that trade. So you can see that when we monitor a few pairs, we have some good opportunities. In fact, On the 5-minute time frame with the max, and especially with the max, the max standard, we have on average 3 to 4 opportunities per day. So 3 to 4 opportunities are on average, sometimes less, sometimes more. It's more than enough to trade. And so when you monitor between 4 and 6 pairs, you have more opportunity in general than you can handle. And among them, you will have some winning trade and you will have some losing trade, of course. And on average, we have a winning rate of around 75%, sometimes a little higher, sometimes a little less, depending on the market conditions, depending on the volatility of the pair, depending on the time frame also. Usually with a higher time frame, the winning rate increases. But with higher time frames, we have less opportunities to scale in. Or we need to have a real long-term movement. For example, if you consider the pound yen these last weeks, if you consider the euro-US dollar these last months, during almost 2 years, a nice downtrend in the daily time frame, then you can use our scaling technique. But usually, with a higher time frame, usually we have less opportunities to scale in. Now, in around 40 minutes, we don't have, during this time period, we don't have important news release in front of us, so we don't have to care for that. But in around 40 minutes, 35, 40 minutes, we will face the Wall Street Open. You see another vertical line here in orange dotted style. This corresponds to a Wall Street Open. You can be surprised, I note on my chart the Wall Street Open, which is the stock market. But remember, all the financial markets are linked together. There are correlations between them, positive or negative correlations. And depending on the more global conditions and so on the events happening all around the world, the smart money moves from one market or from some markets to other markets. And so this is why it is also important to observe what is happening in the other markets. What we observe with our pairs is very often, if the price is making a trend, when we are facing the Wall Street Open, usually, sometimes a little before the Wall Street Open, sometimes right on the Wall Street Open, sometimes a little after. So around the Wall Street Open, we have some retracement. Not necessarily a reversal. It may be a trend reversal, but at least a pullback. And this is observed very frequently. This is why drawing such kind of vertical line on the chart helps to get our attention, to focus on the exit rules at our disposal here, to say, okay, now we are in a time period during the day when we have to pay especially attention to any of the rules at our disposal. Because if we have a pullback, that pullback may be the beginning of a trend reversal. And if we miss that pullback, we miss an opportunity to perhaps bank a profit or to reduce the risk we have on the trade. It's strange enough, but this sometimes happens, that in this pullback, we don't have yet an indication that we can make a scale-in. You can see here on the chart these small diamonds, a red diamonds or a green diamond. Oh, we have one now. And so these diamonds are used as potential scale-in situations. There are other conditions to be fulfilled. In these two examples, we cannot scale in this case. It is forbidden to scale in. In the first case, let me check, perhaps not in the first case. Yeah, in this situation here with the pound, the Aussie yen, we cannot scale in. And in this case, we cannot scale in too, because the scale in will be very, very risky. We have the price having accelerated, and when the price accelerates fast that way, we usually see a pullback. And so making a scale-in when the price is making or is possibly making a pullback, it's not a good idea. Here we have another type of risk prohibiting us to make a scale-in. But we have helps on our chart telling us when we can consider the possibility for a scale-in. So the price now is nicely accelerating in the direction of the trend and so of the trade. And in the meantime, when the price moves in favor of the trade, of course, what we will have to do is from time to time, and the frequency is left to each one, is to adjust the stop loss. And we have rules for that also. We cannot adjust the stop loss as we want. We have specific rules to adjust the stop loss. To take the trade, we have, as I have said, setups. These candles here, this one in the OZ yen, fulfills all the conditions to take the trade I call a breakout remo. That candle here in the pound yen fulfills all the conditions to take a trade corresponding to what we call a PMO, a pseudomo. Okay? Now I'm sure that we are facing an exit condition here. This type of candle, as I have explained, I often explain in our sales presentation that this type of candle we call long bars, and we name them LB by the abbreviations LB for long bar, is an exit condition. But we have to wait for the close of the bar, and it's a little too early on. So sometimes we can miss the exit. But at least we have to pay attention now, because we may have possibly an exit condition appearing. We are at 1 minute and 10 seconds from the close of that candle. The Remo and its variation breakout Remo is a setup, Ralph, for the, or Kurt, for the primer and the light. So we are now in the last minute of that candle. That candle has a length of almost 20 pips. So I will make my MX if the price retraces to that level approximately. So here, so we have rules telling us when we have long bars where to make our MX if the price retraces. With the long bar, we like to see the price retracing before making an MX, because very often this is what happens. After a long bar, the price retraces, but we take the advantage of such a long bar to bank some profit. But sometimes, like it seems to be the case here, the price continues, in which case we avoid making an MX, okay? And then we profit of that situation to tighten more our stop loss. We have rules telling us exactly where to place the stop loss. And you can see now that we have reduced, I have reduced considerably the risk on the stop loss. Instead of having a stop loss of 25 pips, now my stop loss is, let's say 5 pips plus the spread, 9 pips, okay? We have also a long bar here. So 23 pips. Let's see, here the exit should have been made here. 8 pips. I have forgotten to mark it. I hope you will forgive me to make it afterwards. But we are exactly in the same situation here. So long bar. And so here in this here we have two different situations. In the first situation, the exit has been triggered, and I take that MX. And in the second case, on the OZN, now we have the exit. The price crosses my level. I push on the button to make my MX, and so here I have my MX. So I close 1 unit here. So MX1. And this will be a nice profit on both cases. and I can write them on the chart. So the first unit has closed a profit of 42 pips minus the spread, which is, let's say, 4 pips, 38 pips, so plus 38. And in the second case, an even better, relatively speaking, we have 18 minus 3, so 15 pips, which for the Aussie yen is a nice result, plus 15. We can, of course, at the close of this candle, we will adjust the stop loss, but we have plenty of time. And in this case, I can tighten my stop loss. Now you can see, in terms of trade risk management, what the trade risk management consists in. Having banked a profit of 15 pips on the first unit, and having a risk of 5 pips plus the spread 9 pips on the second unit, I am in a sure profit situation. A small profit. If the price in the worst case, in the very worst case scenario, hits my stop loss, I still make a small profit. So I am in a risk-free trade now, here, okay? And in this case, it would be even better. The risk on the second unit is only 17 pips plus the spread 4 pips, let's say 21 pips. 21 pips, which is less than the banked profit. So I am also in a risk-free situation, okay? And so I do that manually, but with the MTM, the max trade management, we have all these numbers. We know exactly at any moment what are the profit we are doing and what is the risk remaining on the trade, or what is the minimum profit we will make if we are in a sure profit situation. So now we have only to handle the trade, and before we have another exit technique allowing us to close the second remaining open unit on each of these trades, we will adjust the stop loss regularly. For example, at the close of this trade, we will be able to adjust the stop loss in around 2 minutes to adjust somewhat the stop loss. Now, in the max standard level, we use several indicators, several oscillators, short-term and medium-term oscillators, and they help us also to define our entry setup. They help us mainly to define our exit conditions, but they also help us to define our entry conditions. And one of the arguments against technical analysis when several indicators are used is the argument of paralysis by analysis. Because if we use several indicators, they may at some moments give contradictory informations, and this is true. And in order to avoid such kind of situation, first of all, the settings of the indicators must be chosen carefully. If we choose them carefully, we may have another problem, which is the problem of the collinearity of all these indicators. By collinearity, it's another term for correlation. I prefer to use the term collinearity because collinearity means that they all represent the same behavior, in fact. With a small difference in the vision, we have to check that behavior. However, they don't have exactly the same timing. And we impose specific conditions on all of them to avoid that concept of paralysis by analysis. With the max, we are never paralyzed when our indicators give contradictory informations. And in fact, if we have contradictory information, we don't care. We don't care, that's all. With the conditions we have in the way to use them, we never care of that type of situation. And so contradiction never happens in the max, never. So in these two charts, you can see that we have green diamonds. The green diamonds represent a potential opportunity for a scaling if we are in a long trade. And so all our diamonds, the red and the green one, are always alternating. a green one will be always followed by a red one, and a red one will be always followed by a green one. And so when you see in a short trade that we have a green diamond, we know that sooner or later we will have also a red diamond. And so with the MAC standard, a possibility to add. But we have to check the conditions to add. So the previous candle has closed. In this case, yes, I can adjust somewhat my stop loss that way. And in this case, yes, I have plenty of place to adjust my stop loss that way. I can even, in this case, set my stop loss at break even. This is not a problem. I'm still in the authorized area to adjust my stop loss. And now we have another conditions, exit conditions appearing here. If this candle closes as a blue candle in around 3 minutes, we may have a potential exit conditions. Again, based on two types of different exit, which will be coincident in this case, possibly. We have a specific price pattern, exit conditions, but we have to wait the confirmation at the close of this red candle, and we may have possibly a bottom in the Stochastic RSI and even a bullish divergence. We have a bottom having formed here in the Stochastic RSI, but this is not for us a valid exit condition. We explain that in detail in the course, of course. You can see now, in particular in this OZ-yen pair, that the second unit is almost at break even, except for the spread, and so the profit is guaranteed in this trade. The minimum profit will be around 0.3R. Now, usually in many textbooks or many other trading systems, it is very often explained that it is better to have a reward to risk ratio larger than 1 to have a successful trading system on the long run. This is not always necessarily the case. It depends, in fact, of your winning rate too, because what is important is not the result for the trade, it's not the winning rate for the trade, is the expectation. So the expectation is the average result on a large number of trades based on the probabilities we have for the trading system. So the candle will close in a few seconds, in around 30 seconds. Let's see if we will have the exit condition here. Okay, the candle is closed. We have indeed the exit conditions, and I will make my exit. So let me see. I will make my exit on this level. If the price comes on this level, I will make my exit. We have also an exit condition here, and in this case also I will make my exit here if the price comes back and crosses my horizontal level here. All these steps in my trading process are defined by our rules, of course. So here the price crosses my level, so here I have to push on the button to close the trade, and sometimes we don't have time enough, mainly when the price is making a very small wick. But now I'm sure that the button has been pushed, and so here I have my exit. We may have some slippage, 1, 2 pips. This sometimes happens, and sometimes myself, especially when I make my entry, I have a slippage between 1 and 4 pips. But here, so we have the XXX. So we close the second unit of the trade. And that unit has banked a profit of 40 pips minus the spread. Let's take a 4 pips spread, so 36 pips So plus 36. And also here in the OZN, x66, and you can see that with a one-click button, it's very easy and very fast to do, then marking the chart. And so here the second unit has been closed with a profit of, let's say 12 pips, 13 pips minus the spread, let's say 3. Let's count 4 pips for a small slippage, so 9 pips, plus 9. Concerning the slippages, 2 times out of 3, the slippage is against me, and 1 out of 3 times it is in my favor, but on average they are neutral. So I don't have a negative impact of the slippages on my result. And now the trade has been closed, we can relax now and we can clean the chart if necessary. We can make some note on the chart. You can see that indeed the price was going against me, and I don't give the price a chance to reach our emergency stop loss. The emergency stop loss is there only to protect the account in case, for example, my internet connection has a problem. And if I cannot handle the trade manually, at least my stop loss, which is a hard stop loss, is there to protect the account. Now, this does not happen very frequently. Since I'm trading live with the MAX, so since the beginning of 2008, this has happened 2 times for me. And in each case, the stop loss has protected my account. So I have been happy because the reversal was very, very important. And so I have made a very small loss on these 2 cases. And so we can mark the chart. So now we have the trade here, number 1, which has produced a result of 38 and 36, 74 pips. And a reward to risk ratio of, so we divide 74 by 2, and then we divide the result by 44, because the stop loss was 44 pips. This gives a reward to risk ratio of plus 0.84R. And in the case of the OZN, a small trade, it was a trade number 2, plus 15 and 9, 26 pips, and so for a reward to risk ratio of plus 0.52R, because the stop loss was, if I remember correctly, 25 pips. Yes, 25 pips. Okay, so these 2 trades, which has been fast trades, so from the entry to the exit we had 12 bars, so 11 plus 1, we have to always add 1, so 12 bar, 1 hour, and so 0.5R, 0.8R, so a total result of 1.3 hours. So if you take a risk of 2%, this represents a 2.6% profit. It is a good profit paid for 1 hour of trading. And now what we do, because we have still plenty of time until the end of the day, we wait patiently for other setups on the same pairs or on other pairs. It is not forbidden when the trades are closed, of course, to check what is happening on the other pairs. Okay? You can see how the price comes back very quickly. And this is very usual. If you remember when the price has made that long red candle, that long red candle has been fast to be made. And when the price moves fast along such a long candle, the price will retrace almost the entire movement. It's not a surprise to see that the price came back right on the top of that red candle. Okay? In fact, and when we check for a larger picture of the chart, what do we observe? We can see that we have a bottom here. Okay? if I draw a line through that bottom, what do we see? We see that long candle, we know that for those who are long in that movement, there are a lot of stop loss here, okay? That fast candle has just taken out all these stop losses. With 1, 2, 3 candles. So all the stop loss here have been taken out. And so this indicates that most probably, the price will now continue upward. This is not a guarantee, of course, but this is a high probability. And there are techniques to trade these kinds of movements. And don't believe that this is necessarily a market manipulation by the brokers or by the dealers or by other big boys. It may be the case, but not always necessary. It may be simply the process of the price discovery. If the big boys want to go long, if the big boys want to buy, they need to find other selling. And among the sales, we may have stop losses for all the other which are long. Okay, and so such kind of behavior may be simply a process called the price discovery, where they bid lower in order to find potential counterparties for their objective of going long. Okay. So you need to refer to the auction process to understand such kind of behavior. But sometimes the process may be on both sides. This is why in some circumstances, we are not always sure what will be the direction of the price movement. And so in this case, until a certain time during the day, if the price comes back and gives me another short setup, I will consider to open another trade. And while I'm waiting for setup, I clean my chart that way in order later to be able to make a screenshot and to save my chart. Now I have always a time limit to consider my next trade. You see here this vertical dotted orange line represents the Frankfurt close, which will happen in around 1 hour and a half approximately. Okay, so half an hour, 1 hour before the Frankfurt open, I no longer consider to open a trade because the time which is left before the European market close is not large enough. So that time period, half an hour to 1 hour before the Frankfurt close, is my time limit to stop trading. Of course, if I am engaged in an open trade at that moment, I will begin to look any of our exit conditions to close my trades. Now, let me explain you something in terms of timing. We define with the max what we call a true trend. A true trend is a movement having a specific length. And when we are in the context of a true trend, which was the case here, not in the Aussie yen, but in the case of the pound yen, and that true trend has started a little before the New York Open and a little after the London Open in some appropriate time period. But this is not the point. There are some criteria, of course, but we're in the context of a true trend. And so when we have such a context of a true trend, what will happen is the following behavior. You see here we have the Frankfurt close and the London close. There will be a time period, in this case, somewhere here, when we will have 75% probability for that trend to exhaust in that time period. Which means that we have still a possibility for the price to resume to the downward and give another trade in such a way that the movement will exhaust in that time period. This does not represent a price level, it represents a time period. And in my chart, very often I indicate that by a red box, which reminds me if I am in a trade and in the context of a true trend, to pay especially attention to that time area. I don't give the exact limit of that time area, this is explained in the course, where to make my XXX. And especially when we have scaling, and you would be amazed how this helps us to be extremely accurate in our exit. Sometimes we pinpoint exactly the bottom or the top of the day, or the bottom or the top of the movement at least. And some of our Max friends have called that box the red magic box because I like to draw it in red. But it has nothing magic. It is simply linked to the market behavior. You know that the most important session in the Forex is the European and especially the London session. And what do we see between the Frankfurt close and the London close? We have all the different European market closing. And when these markets are closing, it's normal to see usually an exhaustion of the movement. That exhaustion will be sometimes followed by a retracement and then a concession zone area or a concession zone. And sometimes we may have a continuation of the trend. This sometimes happens. And it seems that the scenario I have described for the big boy wanting to go long seems to be the case. So let me see if there are some questions I have not answered. So, Nicolas asked, you have any preferred trading session, for example, London session or the overlap of London and US? Nicolas, I trade essentially the European session. There are two reasons for that. First of all, it is the most important session during the entire day. The Asian session usually is a session where or when most of the pairs have small movement. The only trend we see, nice trend we see during the Asian session is on the Pacific pairs when we have an important news release with a surprise on one of these currencies, the yen, the Aussie or the Kiwi. Otherwise, most of the time the movements are small. And I don't trade the second session of the US session, the second half of the US session, also for the same reason. Usually we have smaller movements. Usually the second half of the US session, so after the London close, essentially, is a concession zone area or a reversal trade, but with smaller amplitude. And so I prefer to be present during the European session, which corresponds also to my time zone. Okay? And of course, the overlap of the London session and the US session, the US Open, is a very important one because we have the both continent trading. The overlap is becoming very, very important. Sometimes it has volumes way more important than the volume during the London Open. And I often take a trade around the US Open. Now we may see possibly a new short setups appearing in both the pound yen and the Aussie yen. But we need to wait for the candle to close in around 2.5 minutes. And if these two candles close as red bars, I can say in advance that they cannot be an entry setup bar, because one of the conditions for the setup bar is not fulfilled. And for those of you who are here, because I see some maxers here, you can recognize them. If I tell you the hook, you know what I mean. And so we will have to wait for the next candle and reassess the validity of the next candle, which may be valid or not. Hi, Luca. No, there is no Chatsi today. It is an open house session, so no Chatsi. And Chris is not available. Chris is sleeping, and so it is difficult to consider the Chatsi for the maxers and to have customized answer to their questions. And alone, from my side, it would take too much. It would be too complex to do, because it takes time to explain what I'm seeing on the chart, to explain the decision process, and to mark my charts. So David asked, Davide, I suppose you come from Italy, Davide, asked about 35% of volumes are made during European session, a little less than 30 during the US one. All the rest is spread all around the other 12% is for the other. Yeah, this is pretty much the good numbers indeed. Sometimes more, sometimes less. Which is normal. This can be explained. Okay, now, as I have said, these two red bars cannot be valid setup bar for the reason I have just mentioned, but we can check for the next one. So we will have to wait for the next one to see if it will be a valid entry setup bar. There is also a big difference between the volumes during the Asian session and the volumes during the European and US session. Most of the volumes during the Asian session are commercial trades, correspond to commercial trades, so no speculative trades most of the time. For the London session and the US session, the speculative trade takes a much more important portion of all these volumes. Not the majority, but an important portion. You can see why I mark on my chart here patience and discipline, because we need to wait patiently for the appropriate conditions. That red candle here, or that red candle on the pound yen, on the Aussie yen, I have said, I was seeing immediately that they could not be valid setups. And so we don't chase the price, we don't force the trade. we have to wait for the appropriate conditions. And so if the next candle does not fulfill in each case the appropriate conditions, this will negate the possibility of the trade. Around 1 minute and a half. Okay, Davide, nice to have seen you in the room. How many hours a day I trade? Asked Tim. Oh, it's very variable. Sometimes it's just 2 hours. Sometimes it may be 6 hours. And the maximum is 9, 10 hours. But that's rare. That's rare. The problem is when I am engaged in a trade, we never know in advance how far the price will go. So we never know in advance how long the trade will last. But I like to stay in the trade as much as possible. As long as the trend is unfolding, I stay in the trade. I can see now here the way the price is developing on the Aussie yen. This candle cannot be a valid setup bar. It is a long bar, and so this negates the trade opportunity. So no opportunity here. And in the pound yen, we were with that first potential candle, but we had to wait for the next one. We were in what we call a concentration zone area, and it is a tight one, unfortunately. And so we have to wait for the breakout of that concentration zone. So no trade here for the moment. Now, just to complement my answer to your question, Tim. So when I am in a trade, and when we have a more advanced level of the max to trade, like for such a movement, for example, and we may have several scalings along that movement. And the scaling process allows to increase the profit we extract from the movement. And so the idea is to stay in the trend as long as the trend stays valid, because there are no reason to exit. I'm not a believer of the fixed target profit approach. Fixing a predefined target profit is for me a way to force the market. And I want to take what the market accepts to give me. If the market gives me only small trade like the 2 ones we have seen now, I take them. But if the market is generous enough to give me a larger movement with a larger profit, why not take that entire profit? And so the trade can last 1 hour, 2 hours, 6 hours. Okay, but usually the end of the trade will come, as I have said, with 75% of the case, in the case of a true trend, in that time period around the European market close. Okay? But of course, you are not forced with the max to take all the scalings. If you are happy, if you have made, for example, let's come back to these two last trade example. These two trades have produced a 1.35 R. Okay? Let me write that on the chart here. 1.35 R, which represent with a 2% risk plus 2.7% profit. Okay? 2.7% profit, which is a good daily profit. You know that if you are able to make on average, plus 0.5% profit every day, okay? This is a strong assumption. This forces almost everyone to be a full-time trader. But if you are able to make every day during the entire year 0.5% profit per day on average, at the end of the year by the compound process, you triple your account. With such a small profit, you triple your account at the end of the year. Now, if instead of 1% profit, you are able to make on average a 1% profit each day, okay? And again, with the compound process, at the end of the year, you multiply your account by 8 to 10 times. If you make no withdrawal, okay? So 1% every day, multiply your account by 8 to 10 at the end of the year. And so I can understand why many traders, once they have achieved some reasonable result, can decide to stop trading. I don't have that philosophy. If I am engaged in a nice trend with several or no scalings at all, this is not important, but if I have scalings, I like to milk the trend as long as the trend stays valid. This is my philosophy, and this is the way for me to catch from time to time, not every day, of course, but from time to time, these nice reward to risk ratio of 10, 15, 20 hours. Ah, Rodolfo, nice to see you. Oh, John Paul, nice to see you too. The euro US dollar is bouncing off your priceable area. Okay. Is that realistic? I will check. Many hedge fund managers would be very happy with 15% PA per year, you mean, I suppose. Yeah, but there is something else you have to pay attention. And this is sometimes the advantage we have also as retail traders. As retail traders, we don't trade big lots, okay? We don't trade big lots, big size. And so as long as our trade size is less than around 25 to 50 million dollars, which is a good size, we have no problem to find the counterparties in the market. And this is the advantage for the retail traders. Now the hedge fund or the big traders or the bank who trades larger trade size, 100, 200, 300 and more million dollars, sometimes billions of dollars, they have to pay attention because they will not find their counterparties in the market. And so they have less possibilities to make nice profit. They rarely add to a trade. They add to a trade, but not as fast as we can do with the max, and certainly not in a small time frame, okay? And so this is why these bigger structure have less result in terms of percentage. And indeed, when they make 20 to 30% per year, they are very, very happy. Okay? And so let's have a quick look to the euro US dollar. I don't remember, Paul, where was the level? At 1.094. Let's draw it. 1.094, 1.094. right here. It's a little higher. 1.094, okay, 40, this level. Yeah, this is a possibility. We are not too far from that level, and it's always an area. So we may have perhaps a bouncing off from that level. Yeah, why not? But again, I don't consider these levels, and for those of you who don't know what I'm speaking about, this is something we have introduced rather recently, and it is in a beta test. So we define some types of levels on our charts, and these levels we don't consider they are necessarily predictive. Okay, but when the price reaches these one of these levels, we have to pay much more attention, because when the price reaches such a level, we can still have three types of behavior. The price can cross the level, the price can reach the level, pause, and then continue to rally, or the price can rally reaching the level, possibly pause, the pause is optional, and then bounce off from that level, so drop. Okay, and so this is not automatic, they are not predictive at all, but at least it is an area of attention. And if you add to this level other interpretation like supply and demand, like some auction model, some support resistance behavior, pool of liquidities, and so on, you may interpret what is happening. Sometimes it will be easy to see that one level is a supply level, some level is a demand level. And so you may say, okay, the most plausible scenario will be a bounce off if we are at a supply level. Okay? But again, this is only a probabilistic approach because we are never sure for sure. We are never sure for sure. We are never certain for sure. And you can see here we may have missed perhaps a nice movement, but the conditions to take the setup in the OZN were not appropriate, were not ideal, and this is the way to be disciplined. When the setup is not a good one, we skip it. We don't mind if we miss a good movement. I prefer always to miss a good movement than to be engaged in a bad trade. And believe me, for one movement, for one good movement which is missed, there are many bad movements. And so I prefer to avoid the bad movement than to be engaged in them. The price is accelerating. What is oil doing, by the way? Oh, it's still dropping. So oil is dropping for today. This is why the yen is strengthening. This is the kind of relationship you can observe in the market. This does not mean there is a correlation between oil and the yen, but in the present context, a drop in oil, in the oil price, is indicative of some more important problem in some economies, and so the traders, the investors, goes into safer instrument or safer assets. For the moment, the yen is considered one such safer asset, and it is not a surprise to see the yen strengthening. So we may have perhaps the breakout, the expected breakout here. I may adjust my stop loss, my support level here. Let me check quickly. Yeah. And so this may be perhaps our setup bar. But we have to wait for the close of the candle in 3 minutes and a half. In which case the stop loss should be placed somewhere in this area. This would give us a stop loss. Yeah, the stop loss will be large enough. have said at the beginning of this session, among the currencies, weak Aussie, strong yen. You have the illustration of the type of movement we have. And how can we define that we may have some currencies which are strong, some currencies which are weak, simply by understanding the context, the economic context, the fundamental context. If you simply read, for example, the headlines of the important newspaper or the important news website, you will see that the Aussie was weak, you will see that the yen was strong. And so this helps to define some kinds of directional bias for these currencies and consequently for the corresponding pairs. Let's have a quick look to the euro-US dollar. Price is approaching. It will be interesting to see, to check, but I will check later. One point, one thing some traders do not understand is it's not important to miss a movement. We don't have to fall into perfectionism. In the past, I was a perfectionist, but perfection or the best is sometimes the enemy of the good. We need simply to be good, and so we have to wait with patience for the ideal conditions. And if we miss what seems to be a good movement, that's not important. There will be always other opportunities in the market. So I always advise to our students to be extremely picky with the setups. It is better to trade less, but to trade better. In fact, with less stress. Believe me, when I trade live, I never have stress in my approach, whatever the result of the trade, because I know I will have losing trade, but I know I will have also a lot of winning trades. Dan say, hello Dan, just hit the weekly trend line you sent us. Okay, fine. We don't have the breakout. The price has just closed right on my support level. So we still have to wait for the breakout. You may be surprised, for those of you who don't know the max, why I have not drawn my support level in this area, for example, here or here. But we have rules for that also. We have rules for that. But I'm seeing that we are arriving at the end of our 2-hour session, so we will wrap up very soon. But let's wait first of all to see if this candle on the pound yen will be a valid setup bar for an entry. Yeah, look, indeed, for just 1 or 2 pipettes, the price has not touched the Mo line, but it was close enough just to illustrate the idea of the pseudo-Mo. Okay? There is a small, or there are 2 small nuances I will explain in a future scrolling party, when we will have a scrolling party for the max standard, mainly on the setup bar. because there are some very interesting nuances it is important to take into consideration, and which may give more confidence in the quality of the setup. And so when we have a high quality of the setup, sometimes we may be just a little more flexible in the entire structure of the setup. Because as you know, when we draw a line like this one as a support level is never a thin line. It's always an area around that line. Okay? And so we may have exactly the same kind of consideration for some of the conditions of our setups. Okay? That makes a lot of sense. Ah, okay, nice. And you see, for the moment, the price is nicely respecting that level. This does not mean, of course, that this is the correct level. We never know what is the correct level, except afterwards. But here we are in real time. We don't know the right side of the chart. But if we follow our trading process respecting all the rules, we will achieve the result the max has. Before we wrap up, because we will wrap up now in a few minutes, so if you have some last questions, so please feel free to put them in the question area. Let me just quickly show you on these two examples what the max ETF looks like. I will not show the entire max ETF. So in fact, as you have understood with the max through our sales presentation last Saturday or today, our home base channel and our 3 EMAs play an important role in the way to define, first of all, what is a max trend and what is a max counter trend, and consequently the nature of the setups we have to exploit these trends or counter trends. I teach how to trade a counter trend movement in the Max Advanced course. But this example of the max of the pound yen is a nice example, and we have in fact two situations here. We have that up movement, which is made of a portion of an up counter trend movement while the price was moving upward in a downtrend, and the second half portion is a max uptrend when the price went above the home base. But in fact, the entire trend is that entire up movement. And similarly, we have that nice down movement, okay, which is again made of a counter trend movement and a trend movement, a max trend movement. And somewhere with the max and even the max advanced, I have always felt some frustrations. Why separate these two movements? But with the max advanced, we had no choice because it was how the max has been defined. And so I have found a way to recombine these two components of the entire movement. And so we have built a specific indicator for that, because the max is mainly based on indicator. The indicator is just there to pinpoint the nature or the quality of the trend. Okay, we can add other considerations like other more sophisticated models, more closer to the real price action or to the way the market really works, but the result would be the same. We are seeing that every day. So we have built, to simplify our life, an indicator, which is this one. And I will show only one because we have, in fact, it is a combination of 3 indicators. And let me adjust the setup. Okay, I will take the most dynamic one here. If I drop from my chart all the other moving averages and I keep only these 2 lines, you can see that these 2 lines are extremely regular all along the trend. Sometimes the lines can show also a small pullback, but in the Max ETF course, I I teach how to avoid this pullback or how to avoid exiting too early from this pullback if the pullback is only a small pullback, as it was clearly the case here. And so the indicator here reverses right in this area, which is not too far from the bottom of that up movement, and then reverses here, again, not far away from the top. And then we catch that entire down movement where the two lines reverses in this area, not too far away from that movement. And now the price is going upward, probably with another up movement. And so we are able now to catch the entire movement up, down, and so on. Now, and when you combine this kind of movement with other consideration, like Luca has mentioned, for example, the levels, then we can really pinpoint very accurately the entry and the exit of the trade. And so we have two versions of the MAX ETF. We have what we call the MAX ETF, which is partly what you are seeing here. And then we have the MAX SAM ETF, which is the most evolved version of the MAX, when we use the same type of concept with another type of representation for the price movement, which help us to have better details in the price movement itself. And of course, along such a movement, downward movement or upward movement, we apply all the other concepts of the MAX, mainly how to make scale in and how to make scale out, or the MX. And this provides way larger movement. Instead of opening the trade here with the PMO almost in the middle of the movement, we can open the trade. In fact, the trade would have been opened, the setup bar would have been this one, or perhaps that one. I like to draw my vertical line on a setup bar. And then the entry would have been made here, somewhere here. Look, the entry would have been here around 45 pips earlier, with one potential scaling, then one potential scaling, at least one scaling. And so the result would have been completely different. Instead of having 0.8R, perhaps this would have produced a 3 hours profit or a 5 hour profits. Okay? So this is what the MAX ETF is. So Dan asks, thanks so much for the session. It's always a pleasure to hear Xavier sharing his knowledge. Oh, thanks, Dan. Well, I wish you a nice day. Be prudent if you trade this week, because don't forget Friday is the non-farm payroll. By the way, we have the second session this Thursday for the London Open, so at 9 a.m. Brussels time or 3 a.m. Eastern time, New York time, so for the London session. And the London session usually has another dynamics than the US Open. So I hope to see all of you next Thursday, and so in the meantime, have a great day. Bye everyone.